As we entered 2023, numerous predictions cast a shadow over the financial landscape. We are now in June, the midpoint of the year, without experiencing the anticipated downturn. Yet, beneath the surface are potential dangers, including high interest rates and sluggish GDP growth. Meanwhile, the AI and tech sectors thrive, fueling market confidence and propelling the stock markets to new heights. In this video, I'll look back into market history, evaluate the impact of high interest rates on previous crashes, and give insights on how the market will move forward in these heightened times. The spike in AI stocks has piqued our interest in recent times, especially in the high-interest environments. Two lingering examples from the previous market crashes, the 90s dot-com bubble and the 2008 financial crisis, are still relevant today. High interest rates were the background for these two events. Let's briefly review what happened. During the late 1990s, interest rates were raised to combat the soaring inflation. This period coincided with explosive growth in internet adoption, therefore a surge in venture capital, and therefore high valuations of new dot-com startups. However, the euphoria came to a screeching halt when the Nasdaq index peaked in March 2000, only to plummet by a staggering 70% within the next 2 years. This dramatic decline underscores the vulnerability of overvalued technology sectors to the impact of high interest rates. Similar to this, there were high interest rates in the years leading up to the housing market collapse that caused the 2008 financial crisis. The Nasdaq index dropped 50% from its peak in 2009. This serves a reminder of the consequences that high interest rates can have on the stability of the markets. If nobody has told you why a high interest rate is bad for the technology sector, then I'll walk you through here. Assume you own a company and design the products that will be launched next year that will be worth $1,000. In a high interest rate environment, such as the current Fed fund rate of 5%, your product is discounted by 1.05 for 2 years, then you have to discount twice. And for most of the technology products that are laid out far into the future, for example, 5 years, then it has to be discounted 5 times. And the results? $783. In contrast, in a low interest rate environment, such as during the tech boom between 2009 and 2015, when the interest rate was 0.05%, even discounted 5 times, your product is worth $997, worth a lot more than in the high interest rate environment. This calculation shows how high and low interest rates can impact the technology valuation. You might ask, how long will these high interest rates continue to be? Then we have to look at the inflation rate and personal consumption expenditure, PCE. In April 2023, the annual inflation rate in the United States decreased to 4.9%, marking its lowest level since April 2021, and slightly below market forecast of 5%. While this decline seems promising, the core inflation rate, which excludes food and energy items, tells a different story. The core inflation rate remains high, fluctuating from 5.5 to 5.7% over an extended period of time. This sustained elevation raises concerns as it is still higher than the median target inflation rate of 2%. Additionally, the core PCE, a crucial indicator monitored by the Federal Reserve, hovered between 4.6 and 4.7%. These figures highlight the persistent pressures of inflation and pose challenges for monetary policymakers. Maintaining a balanced viewpoint is critical in the middle for AI breakthroughs. While AI has numerous potential to benefit numerous industries, it is critical to remain cautious and learn from the history. Interestingly, market confidence can be self-fulfilling. assisting the markets in crossing the hurdles of high interest rates. When investors have unwavering faith in AI development and its disruptive potential, it can fuel long-term market growth. We've seen the recent rise of AI stocks, the historical impact of high interest rates on market collapse, and the delicate balance between market confidence and AI growth in the current status of the stock markets. As we continue our journey into the second half of 2023, it is critical to learn from the past and approach the market with both enthusiasm and caution. That's all for today's video. If you like this video, please like and subscribe. In your investment journey, you will always be richer than yesterday.